Hello folks, so you're once again welcome back to my channel. This is going to be a very brief video. Today we are on step index. So step index is one of the synthetic index pairs that um, Derive as a broker offers. And so what step index actually represents is just one of the synthetic index that usually has equal pace in its movement. Okay, so with step index, it equally is very volatile. So for instance, watch this. You could see that it up and down movement has an equal pace. So if it offers you 10, for instance, the least pip, the least lot size you could use is either 0.10. Yeah, so each movement may represent 10 cent per trade. So any trade you take, each movement represents a cent. So upward movement, if it moves one, it's a 10 cent movement like that. So the same when it goes into 20 is a 20 cent movement per each movement. All right, so it's one of the asset pairs that um, Derive offers. All right, so today I'm here to share with you what I call the mistake I made that made me miss out a $200 trade setup, or you can call it your $500 trade setup. Okay, so what was the mistake? Let me quickly take you through the video for you to see the mistake that I made, that I have learned from, that I'm going to help you avoid that mistake. All right, so quickly, this is volatility. This is step index. Now on the weekly time frame, step index was moving from a particular point. It traded down from a high to a low, and then what happened was that it shifted course. Okay, what I mean is that the structure shifted. Okay, so we had a break in structure to the upside, so we expected market to come down and sweep all the liquidity resting below. So we had a high in here, market traded down, came in to sweep the high, which made us aware that the market has shifted course. So quickly, we will see a reversal. Market reversed back into an area of interest, and then we saw a reversal back up. Okay, I haven't really paid much attention to this particular asset pair because I don't really trade it. All right, but then a quick one for you to see that there was a trade that you could have taken that could have easily given you profit. So as at the time that I saw the market is what I'm going to comment on. Okay, and for you to learn a few things. All right, so market had already dipped into this area, reversed, taking the high. So I was expecting that, well, market had come in here, traded into this particular area. I was expecting it to normally trade back up. But then watch this. Market trades into this area, now reverses, comes back into this area, sweeps the low resting in here. What do you think normally has just happened? We may think that the market has shifted course. So, well, as it has swept the low, we could see that another course has been shifted. Yeah, it's probable. But then what I saw was this. I saw this long wick candle in here. Price on the weekly time frame, price has closed in on all the fair value gap resting below the side. So my expectation was that price, as has dipped into this fair value gap, closed in on these areas, dipped into this other block, and price was rallying back, and all this long wick candle, as it's also dipped into the mean threshold of this same other block and was rallying back up. What I saw when I saw was 2 weeks ago was this particular bullish candle, bearish candle here. All right, so let me zoom out. This bearish candle was when I saw the chart. So I expected that market had to do whatever it has to do on the lower side, and then we see a reversal back up. Okay, So quickly, let me show you this. Now look at this. This area that I have indicated is into the mean threshold of our order of the wick resting below this area. This area that I have demarcated is the long wick that is resting in here. And what I expected was that price was going to dip straight into the mean threshold of the wick, and then we see a reversal back up. Now let's go down to our daily time frame and see what is happening. So price came down just at the mean threshold of where the wick is also another area where we had a small fair value gap resting in here. So I expected price to do that. Let's go down to our 8-hour time frame. So on the daily time frame, I expected this gap to be closed in. Let's go down to our 8-hour time frame as well. On the 8-hour time frame, beautifully you could see that there was a mitigation in here. So price dipped, came up here, formed this, and then dipped again, and then it rallied back up, and then went to close above this high here. So I consider this area as a mitigation. Okay, so I expected that price should trade into this mitigation, which is the last bullish candle up here, this bullish candle. So when we are dealing with mitigation, this is the candle that these are the candles that we consider the last bullish candle before the drop and then the rally. So this large bullish candle. So you could see that price traded into the wick of this bullish candle resting in here, and then it rallied back up. All right. So beautifully, so I placed my trade in here. This wasn't the lot size this was the original lot size I used, but I placed multiple trades, which if had triggered, which I didn't monitor the trade, if had triggered, I should have been making about $500 more, $500 or more now, which it didn't trigger. Nevertheless, we don't run after the market. Okay, whatever trades you place and it doesn't trigger doesn't mean that you should run after the market. Wait for another good opportunity to enter or execute a trade. Okay, so for instance, if I was someone came and had met that, oh, my trade didn't trigger, they begin to buy anywhere up in the sky. You would have bought here, price brought you down all the way, stopped you out and all that. So whenever you see that price leaves your trade or doesn't trigger your trade and it runs, don't chase after it. All right, that's a good advice that I'm giving you. Don't chase after price. So beautifully, let's look at this. So on the 8-hour time frame, I expected it to do same. Let's look at it on the 4-hour time frame. So on the 4-hour time frame too, good, beautifully, this is the last bullish candle up here. This is the mitigation. So I expected it to come hit it. Look at this continuous order block in here. It also hit it, and then it rallied back up. The trade missed my trade by a pip, and it was amazing how my trade was not triggered. It was amazing. So imagine, look at where my trade is and look at the difference. It was so much amazing that the trade didn't trigger, that I missed this entry. What is the lesson that I have learned in here? From my mentor Michael, whose birthday is coming soon, all the time what he does is that he has to give a little bit of not too much, so close to for instance, where your entry might be, I was expecting it to hit the top of this bullish candle as the mitigation area. One important thing to do is give it a little bit room and make room for about, because of the spread that sometimes the brokers offer, give it a room of about 5 pip 2 to 5 pip, or that's too much when depending on your lot size, but at least give it a little bit room, at least 2 to 3 pip, depending on your broker and the kind of spread they offer. Give it a little bit room in such a way that your trades can be triggered at a particular point where you least expect it to trigger. All right. So this was my mistake. I didn't give it room. I didn't consider the spread. The trade was so tight that it couldn't trigger. So this is my little advice, that anytime you are setting a trade, give it a little bit room. All right. So this is just an advice that you can add to your journal. So if you are new to this channel, do well and subscribe. One advice that I always say is get a journal and record all your mistakes. I don't call it a mistake. I when you say mistake, it makes it feel like you did something that is extremely terrible, that yeah, you condemn yourself. I call it a wrong execution, wrong entry. All right. I put the reason why I missed this trade in my journal. Another time I know that I learned from all these wrong entries. All right. So this is where I'll quickly leave you with a volatility, sorry, step index. All right. So I'm going on to give you more updates on other videos. So I wish you all the best. Thank you for sticking with me. If you are new, please do well. If you are old too, thank you for coming back to watch the channel. Thank you for supporting the channel. You are the best, and I wish you all the best in your trading journey. Enjoy the rest of the day.